It has one of the lowest company tax rates in the developed world and is a well-known haven for financial institutions, but they're not the only ones. I've come to Singapore, a country with no natural gas reserves that's now one of the world's biggest traders of it. And much of that gas is Australia's. It all leads to questions about why so much gas is traded through a tiny, resource-poor country that's thousands of kilometres from most of Australia's main LNG customers. In the $500 billion a year trade, one company stands tall, Shell. It's the world's biggest player and one of Australia's biggest producers.
Shell accounts for around 1/5 of Australia's LNG production, and Australia accounts for around 1/4 of Shell's global LNG supply. So Shell is extremely important for Australia's LNG industry and vice versa.
Over the past decade, the island nation has become an increasingly important part of its Australian LNG business. Our export market works like this. For example, Shell extracts the gas, cools it to a liquid form, and then puts it on a ship. About 80% of the gas Australia produces is exported this way, mostly under long-term contracts with North Asian countries like Japan, China, and South Korea. But it's the spot market where there's real money to be made. Additional cargoes aren't locked into long-term contracts. It's gas that could be sold back into the domestic market. 4 years ago, as Australians' gas bills soared due to the war in Ukraine, the competition regulator realised an exporter had sold all its extra cargoes to itself for prices significantly below the international spot price.
Shell confirmed the ACCC's reporting that it was effectively selling to a related Shell entity in Singapore that would then on-sell that gas as part of Shell's global portfolio.
By doing this, gas exporters can shift profits outside of Australia's tax net. None of this is new information, but what is new is just how much money Shell made doing it. According to company documents, between 2017 and 2024, Singaporean-based Shell Global LNG bought $83 billion of gas. It then sold for $105 billion. That's $22 billion more than it paid for it. About 85% of that gas was sourced from other Shell companies, including those in Australia.
I don't know the exact amount of Shell's equity LNG in Australia which goes through its trading hub, but I think the trend would be that companies like Shell are looking to move more to a portfolio model and have more of their LNG equity supply flow through their trading hubs.
In the 8-year period, Shell Global made a pre-tax profit of $2.8 billion. It paid $178 million to Singaporean authorities. That's a tax rate of 6.3%, which isn't bad when you compare it to Australia's corporate tax rate of 30%. Shell acknowledged that most of its Australian gas was sold through Singapore, saying the island nation provided access to markets and had significant expertise in trading, marketing and shipping. Jim Killaly worked for the Australian Tax Office for decades. Based on public information alone and not his time at the ATO, the former Deputy Commissioner says Shell's Singapore trading arrangements are a red flag.
You've got an Australian entity dealing with an entity that has a base in a low tax jurisdiction. It's happening over a number of years. The margin of $22 billion US is very significant, and the parties are related. To me, the warning bells would be ringing in terms of whether there's a profit-shifting risk there.
Shell Global was likely not the only Shell company selling Australian LNG through Singapore. Another, Shell Eastern Trading, reported similarly eye-popping numbers.
There's absolutely zero reason why those trades could not be done from Australia. The primary reason why they're not done is because that would incur significantly higher tax payments to the Australian government.
In a statement, Shell said the company prepared a voluntary tax transparency report showing all taxes paid in Australia each year since 2016 and has an ongoing and transparent dialogue with the Australian Taxation Office under its Justified Trust program.
ultimately this becomes a game where the industry will try and minimises tax as much as legally possible, and the tax office is aware of that and makes its rules accordingly to limit the industry's ability to do so.
Shell stresses it's one of Australia's biggest foreign investors, and oil and gas companies account for 1 in every 10 company tax dollars paid. Jim Killaly says that may be true, but using Singapore as a trading hub may be masking the real value of Shell's Australian exports at a real cost to taxpayers.
And the fact that a tax payment appears quite stunning in terms of being quite large doesn't, by virtue of that fact, make it the right amount of tax. Because if your profit is a multiple of your tax payments, then it may well be that you have to be paying a lot more tax.
Back in Singapore, the game of shells goes on, with billions on the line.